I think we come to the question and answer session, if I'm not mistaken.
Absolutely. And I think we have about 60 questions that haven't been answered yet. Several of them are group questions. So I want to start and go through those. And I believe we have a good amount of time to be able to get through those questions, and they do range. And Lee or Gabe, we can go back to whatever slide you want in the process of answering those. So the one that I would probably start with that I've seen from our attendees to you, it really revolves around the number of employees eligible when we're talking about PPP. Easy to slip and use the personal protective equipment acronym right now.
Right.
So who's included in the PPP calculation? Is it full-time employees? Does it include full-time and part-time employees? Does it include 1099 contractors? And how do we calculate the number there? And is it 500 FTEs that is the presumed limit there?
So again, I'll caveat my answers by saying that we are lobbyists. I am trained as a lawyer, but I don't practice law anymore. And we're not accountants. So we will give you our best reading of the language of the bill, our understanding of the SBA, and things we've heard. To answer that first question, you can, for purposes of calculating payroll, we believe you can count full-time and part-time employees. We do not think will be able to include 1099 simply because they themselves are eligible to seek PPP loans. And so if they did that, there would be a double counting. You would get them added to your payroll, which increases your loan, and they get their own loan. So I think it's a pretty good assumption that only full-time employees and part-time employees can count toward calculating your payroll costs. Now, in terms of the number of employees, my understanding is 500 is the limit. They could be part-time, full-time, but 500 human beings, you cannot go above 500 workers who work at any amount of time at your organization and still be a small business. So under 500, any workers that are on payroll. Not an FTE calculation.
Thanks, Lee. I think that's a great answer to that particular set of questions. And one thing that I'll make clear in answering some of these questions as well is that because you're seeking a loan directly from your lender, we have some more information that we can make available on our COVID-19 resource page that is clear guidance to lenders that was recently put out there by SBA and by the Treasury for PPP. So some of this your lender is going to have guidance on and can answer you on, and that's really who you're working with for PPP. So the next question that I have, and it is from Mike Neff, is if we are an independent but maintain our 501c3 under the group exemption of a larger organization, like a garden's under the umbrella of a religious organization, and the larger organization has more than 500 employees, are we still eligible? Meaning, if we have a separate 501c3 entity and we're applying for relief through either EIDL or PPP, are we dependent upon a larger organization for that, or can we apply independently?
So in terms of the ability to apply, it comes down to ownership or control. Does the parent organization control or own your organization? Which is to say, a majority of your organization. And if that parent has more than 500 employees, or if you together between the parent organization and your organization are more than 500, we believe you will not be eligible to apply, even if you have a separate 501c3.
Thank you. doing my best to answer things as we move along. Another question that comes up that's a group of questions is has to do with how you calculate payroll and when you calculate payroll for the purposes of, say, PPP. The questions in general fall into this sort of grouping. First of all, if I had vacant positions and I wish to try to fill them because I've had a vacant position for a while, how would I reflect that on the request for assistance when that position has been vacated and it was vacated after, say, the period in 2019, so after June of 2019? And then the related question to that is also, if my total payroll increased, if I added positions in 2019 after that, should I be using the January to February period for my calculation for payroll?
So the first question about vacated positions, they're really looking at your actual payroll, not position. So if the position was vacated and you're not paying anybody on a monthly basis to do that work, I don't believe that would count toward your payroll costs. In terms of adding people after June 30th of last year, and this is for purposes of, well, first, to calculate the size, the maximum size, looking at the average payroll costs monthly payroll costs in 2019. So that is likely to be different every month depending on number of employees or other factors. They'll take your total 2019 eligible payroll costs, divide that by 12 times 2.5, and that gets you the maximum loan that you can take out under PPP. Now, in terms of using, for comparison purposes, when it comes down to the forgivable portion of the loan, you'll want to just do an analysis to look at how many FTEs you had in the period February 15th to June 30th, 2019, and how many in the period January 1st, February 29th, 2020. Clearly, you want to take the lower FTEs of those two periods because that's going to be the denominator in the factor that factor that they used to determine if any of your forgivable amount of the loan will not be realized by you. So if they'll reduce the amount of the loan that is forgiven.
All right. I think it's a very similar question, and I want to make sure that it gets answered directly for you in the words that it was asked. So Johanna McBrien asked, we have a position that has been filled for years and became vacant this March. This March, we also hired a replacement, but with COVID, asked her to wait until starting because of the financial hardship. Since we are filling an existing position and not creating a new one, can we include her payroll unchanged from 2019 as long as it happens before June 30th, 2020? And I think we did a good job of defining employee, full-time, part-time, but what about 1099 contractors? So there's really two questions here. The quick one to answer would be, is a 1099 contractor eligible, yes or no? And then Johanna's question more specific toward a position that was hired, but not necessarily quite yet on payroll. They hadn't started yet.
Again, I think on the 1099 contractor, we believe you will not be able to count that toward your payroll costs simply because that contractor has the ability on her own to seek a PPP loan. So again, it would be potentially double counting where you'll be able to increase your loan size by counting the independent contractor, and she would go after a loan on her own. So I think it's a pretty good assumption you cannot count your 1099 contractors. In terms of people that so on the rehiring side, there is a bit of a window. So if you have reduced people between February 15th and April 26th of each year, as long as you get back to that same headcount by June 30th, there's no penalty to you in terms of the reduced headcount. So if you've hired somebody now, it depends on when you get your loan, right? So we're calculating the FTEs starting from the covered period, which is when the loan is extended to you plus 8 weeks. So let's say you get your loan on April 15th, then it would be June 15th would be that covered period, essentially. So you're going to compare that covered period to your total number of FTEs, either in the first 2 months of this year or the period February 15th, 2019 to June 30th, 2019. And again, you're going to look at, of those two comparison periods that you get to select, which has the fewer FTEs, so you can minimize the amount of forgivable loan that you lose.
Thanks, Lee. A question about a slightly different question, because I want to make sure that we're covering all kinds of questions here. The tax credit on ineligible during the PPP 8-week period. Can you talk a little bit more about that as well? And about that 8-week period and whether or not there are tax credits there.
Under the tax credit, under the PPP?
Correct, yes.
On payroll tax.
Right.
Sorry, yes. So that's a separate program. So that's not part of the Paycheck Protection Program. It's a separate portion of the CARES Act. It allows you to take a credit of up to 50% of your payroll tax credits on your FTEs, the people that you maintain on your payroll. So that's separate from the Paycheck Protection Program that is available to all employers as far as we know. The details of that will be rolled out, we believe, sometime next week or the next week. This is Paycheck Protection Program week, the federal government. Next week, they'll probably start rolling out the details around the loans for larger companies, as well as the payroll tax credit requirements and guidelines.
Okay. The next question is, and I apologize to all for sort of jumping around, but we want to make sure that since we have about 75 open questions that we're answering different questions that are being posed. If I apply for an EDIL loan as a nonprofit, is a guarantee still required, and who is the guarantee? So just sort of a question about what a personal guarantee is and who is necessary to guarantee.
That's a good question. I'm not sure of the answer to that one. Under the EIDL, there's a requirement for personal guarantees for loans over a certain threshold, for sure. We've looked at that from the perspective of a for-profit company, not from a not-for-profit. So that one I can't answer. I don't know the answer. We'll try and get back to you, Casey, and you can share the answer with your members.
Okay, great. We had a question about interns and seasonals and seasonal employees. Would they be covered under PPP forgiveness if they were not 1099 contractors?
Yes. So they're going to look at your FTEs. We have interns at our company. So I'm looking at them because we'll end up doing a PPP for ourselves if we're permitted. Again, you're looking at, it's an FTE calculation. So if your interns are working 20 hours a week, that's half of a person. If your seasonals are working 3 months a year, that's a quarter of a person, or FTE, I should say. So they're going to look at your payroll for 2019, and they'll look at FTEs, within those months to see how it plays out. Now, again, for measuring purposes, for forgivability, you're only looking at 2 different periods, February 15th through June 30th, or the first 2 months of 2020. So, but within those 2 measuring periods, they're going to look at all of your payroll employees, whether they be full-time, part-time, interns, seasonal, whatever it is. They're going to look at that in calculating your overall FTE during those measuring periods.
Fantastic. So a few more basic questions to rotate back to. The first being around sort of who besides 501c3 nonprofits are eligible for either EIDL or Paycheck Protection Program. And specifically, we have a few of us are joined today who are affiliated with a university system, for example, or a municipality. So in one case, we have one query that is the Friends organization of the University Garden is the 501c3, but the university system also does some support. So the Friends system, the Friends doesn't necessarily have employees, but the need for coverage for, say, lost revenue from programs and some other things is still there. How would they either use PPP or EIDL? And then I have another classification to run by you.
So for PPP and EIDL, I don't see a reason why universities, which are nonprofit organizations, would be excluded. Now, that may change. There might be some guidance from SBA about that, but nothing on the face of the language in the CARES Act or what I've seen so far would exclude the university from seeking a PPP or an EIDL loan. Anything municipal or government would be excluded because it's not a nonprofit, it's a public agency. So no government entity could seek a PPP or an EIDL loan.
But Lee, wouldn't the university, if it was a large university, be seeking it for the entire institution and thus?
Well, yeah, so it would have to be a relatively small school, so under 500 employees. Yeah, so it would, if it were a department of a larger university, they could not seek funding because of the affiliation rule. They'd be tied back to the larger university itself. It would need to be a pretty small university with less than 500 employees. You're talking about a real small university in most cases.
Mm-hmm.
Yeah, so really the key here is that 500 employee limit. And then looking at the affiliation. So if you are part of a large organization, in between your employee count and your parent organization employee count, you're over 500, then you're going to be knocked out. You won't be eligible to apply for, in either case, Paycheck Protection or in EIDL, with the exception under Paycheck Protection of the food and beverage, the food and drink industry, basically. So food, drink, entertainment, bars, restaurants, they're waiving the affiliation requirement when it comes to restaurants.
Fantastic. So another question is about the proportion of forgiveness that occurs if you've already laid off staff and
Right.
don't foresee hiring them again. Can you talk about that, about organizations who have already laid off staff and how they would still be able to seek recourse under PPP?
Sure. So let's assume you've laid off people before February 15th. For purpose of calculating the total loan amount, that's not going to matter. Let's say you laid them off between January 1st of this year and February 15th of this year. Remember, we're calculating the total loan amount based on the average monthly payroll from 2019. So that's going to give you the maximum loan that you can go for from your bank. Laying people off between January 1st and February 29th of this year will impact the forgivable portion of that loan, because in either case you've dropped headcount, whether you take the measurement from assuming that that person worked for your organization all of 2019. In either case, whether you look at the period February 15th through June 30th, or January 1st through February 29th, that person would have been counted. So that increases the denominator, the head count. So you would fall below 1 as what you're multiplying against the loan amount. That will result in reduction in the forgivable portion of your loan. So again, just to make it simpler, most staff reductions before February 15th will not affect the total amount of the loan you can get, but they are likely to affect the forgivable portion of the loan.
All right, great, thank you. So the next series of questions is sort of what's included in payroll. So for example, are workman's comp payments included in payroll for PPP? Are health insurance payments and or employee contributions included in PPP for health insurance payments? Is federal withholding as a part of that, and is Social Security a part of that calculation?
So federal withholding and FICA, Social Security and Medicare, are both excluded from eligible payroll costs. So you gotta back that out. That's as of today. Now, things could change tomorrow or Friday, but as of now, if you look at the clear language in the CARES Act, it doesn't, you have to back out federal taxes under IRS chapters 21, 22, and 24. And that's basically FICA and federal withholdings for income tax. The employer portion of healthcare or employee benefits programs is includable. The employee portion, I don't think doesn't seem to fall under the list of eligible payroll costs. We'll have to look at that again just to be sure about it. What were the other ones you asked about?
Workers' comp insurance and also the different withholdings that.
So workers' comp would be interesting. That's going to come down to what the bank thinks, I suspect. So when you apply to your bank, they're going to let you know exactly which payroll costs you can include. And again, we're still waiting on guidance from SBA on which of the employee benefit programs are going to be included as part of permissible eligible payroll costs. But again, on the withholdings, you will not be able to include withholding for federal income tax, withholding for FICA, but you will be able to include withholding for state taxes and local taxes.
Fantastic. Okay, the next question is a sort of a series of questions about double dipping. So tell us a little bit more about double dipping. For example, if we apply for EIDL, do we lose any tax benefit under COVID-19 provisions, such as tax payment deferral to 2021, 22, and or tax credit? So how, and just some general guidance about what the nature of the double dipping is, and
so
can't be any, but how would a business divvy out what they'd be asking for and why?
Yeah. So you can't use proceeds from a PPP loan or an EIDL loan for the same expense. So for example, you couldn't use the proceeds from those two programs to cover payroll, but you could because the PPP is a more limited universe of acceptable, permissible costs that relate back to them being forgiven ultimately. So you could take an EIDL and use it for example, paying down debt, or paying accounts payable, or some other operating costs. That's use the EIDL for that purpose. And then the Paycheck Protection Program you could use for payroll, rent, and utilities. So as long as you can segregate the funds that you're getting from those two loans, you should be able to have two loans and use the proceeds to cover different operating expenses. But again, you can't cover payroll twice. You're using PPP and using EIDL.
Fantastic. Thank you on behalf of April for that. So another general question in terms of filling out the application process. So if you're a 501c3 and also less than 500 employees, should you check the first box on the EIDL, or is there any advantage of checking one box over another? Lee, you can answer that one, or Kate will probably answer that in her portion of the presentation.
I think I would check the nonprofit box. Yeah. So whether that be for paycheck protection or EIDL, just check the nonprofit box.
Yeah, I think that's generally pretty sound advice, because from what I can see, some of the limits on 501c3s will go by business sector, and I think we'll see that a little later. Okay, a few more questions. What forms should we use for our payroll numbers, and maybe a little bit more of information on the $100,000 limit? Is what constitutes going over that $100,000 employee limit? Is it just wages, or is it total compensation?
So any payments that are run through payroll to an employee count. So you're gonna have whether it could be wages, it could be commissions, it could be bonuses. That's all going to count toward the $100,000 limit. So you can't hide additional payments as bonuses or commissions. It all is going to come down to the 100,000 limit.
All right, and then the forms, the preferred forms to use for payroll numbers. The question is, would I use a 941 form or another form?
The 941, I believe it is, right? That's what we've been told by banks to collect. There could be other year-end forms. For example, your payroll provider may have a year-end general ledger form that breaks out payments to employees. So it would separate out, for example, what you paid on their behalf, or what they paid for FICA, for federal withholding, for state and local tax. So if you can get a year-end general ledger from your payroll company that will break out those costs, it'll be easier for you to calculate the maximum amount of your loan based on that general ledger. I would work with your payroll company, and of course your bank is going to tell you exactly what they want to see from you in terms of payroll records, potentially P&Ls, balance sheets, and other documentation that they're going to require for you to get the loan.
All right, so now just a question about lenders, since PPP goes directly to your lender. So I've got sort of two variations on that for you. The first is a lender, and they're supposed to be sort of ready to go by Friday, but one of our participants is saying that their bank is telling them that they're not ready to go by Friday. Does that put that particular organization at a disadvantage? Like, should they wait or should they get in now? And then in my mind, related to that is another question of, do I have to go through my current bank or my current lender? Let's say, for the sake of argument, that I don't really like my current relationship with my bank. Can I go look for another lender?
All right, so in the first question, I think if you've got a good relationship with that bank, it's worth waiting a couple days while they get up and running. So I would ask them when they think they're going to be ready to accept the Paycheck Protection Program applications. And if it's going to be Monday or Tuesday of next week, you should be fine. Again, there's a lot of money available here. We don't foresee them running out of money in the first week. Yeah, small businesses can apply for funding, for-profits can, starting on Friday, and then they'll go to, and nonprofits as well. Then they'll go to independent contractors a week from Friday. So if your bank is only delayed a couple days, that's not going to be material to your ability to get a loan. And I do think it's important that you have a relationship with a bank, because banks will take care of their customers first. If they get 100 applications in, they're going to look for their customers first among those applications, take care of them, and then move on to non-customers. So on the second question, unless you've got a terrible relationship with your current bank, I'd recommend sticking with them because they know who you are. But if it's a bad relationship and you want to get out of it, you can look at other banks. I'm just not certain that you'll get the attention that those other banks' customers would get. So you really got to weigh in your own mind the importance between the relationship you've got, and if it's a good one, you want to move forward with that bank, even if they're delayed a couple days in getting their process up and running. And then if you don't have a good relationship, you could look at a different bank, but recognize you might find yourself in the back of the line behind that bank's customers.
Okay. The next question relates to institutions that have variable payrolls during the course of a season. So at the outside of the given portion of the year, they ramp up with a lot of seasonal employees, say between May the 15th and the end of October. But in between the beginning of the year, say between February and June, they may not have that large of a payroll.
So I think it depends on if you are a seasonal business or just a business that has a varying payroll. If you are a seasonal business, then they'll measure the payroll expenses over a 12-week period starting February 15th or March 1st at your discretion, your choice. If rather you are a year-round business that just happens to have a bigger payroll in certain months, then they'll probably default back to the standard to look at all of 2019, your average monthly payroll costs. So again, it's going to be between you and your bank to determine if you are a seasonal business or just a business that has a varying payroll.
So tell us a little bit more about the 25% reduction for those of us who've been laid off, or sorry, not myself, but for those who, if our business has laid off people and we're in the process of rehiring, the 25% variability, does that layoff period in which we've had people laid off, does that count against us? Or is the 25% test applied to annualized pay rate?
Good question. So if you have laid off people between February 15th and today, you can rehire them up until June 30th, and you will not have any reduction in the amount of your loan that's forgiven. The 25% standard only applies to employees who are employed in the covered period. So from the day you get your loan and then 8 weeks forward. And again, it only applies to employees who make less than $100,000 a year. And then for those people who make less than $100,000 a year and were employed during the covered period, those 8 weeks, if you're getting your loan, if the reduction in their pay in that 8 weeks is more than 25% compared to their pay in the most previous quarter, then you'll see a reduction in the amount of your loan that's forgiven. And this is an employee by employee test. It is not an overall payroll test. It looks at individual employees that were employed during the covered period to see what the impact was, if any, on their pay.
Thank you, Lee. That's a great question that I know has been on everybody's mind. So how does the CARES Act, just a big picture question, are there definitions within the CARES Act of what an at-risk institution is?
It's a good question. I have not looked at that, but you know, there's only when you apply for the loan, you've got to certify certain things, and the certification you have to make is that, and this is under the SBA application form that was issued yesterday.
Yes, but Lee, if you could also answer it in the context of some of the other forms of assistance. So it's sort of CARES Act. It would actually include funding for NEA and NEH as well.
Yeah. So we know more about the PPP than NEA and NEH. So I would just tell you, there's no necessity to demonstrate you're at risk. You don't have to show up and say that I'm going to lose this contract or lose this amount of revenue or whatever it is. You only need to certify that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That's literally a checkbox. As long as you, in good faith, can certify what I just said, that demonstrates that you've shown necessity for the loan.
Sounds good. And I
would tell you that we are recommending to clients that you have a little memo in your back pocket where you lay out, you know, your own reasoning for necessity. So you want to have a one-pager that just says, here are the reasons I think the loan is necessary. Not that you'll be called on it. We think the banks are probably going to be extending forgiveness because they get 100% of the loan paid back by SBA. But in the very remote circumstance that some bank says, okay, demonstrate to me that this loan was necessary in the first place, then you'll be able to tick off the reasons it was necessary.
Sounds good. A general question about the PPP application in terms of who the owner is for PPP application purposes of the nonprofit. Would that be based on the bylaws of who, say, the fiscal agent was, or who is conducting the point person for everyday business affairs?
Yeah, it's probably going to be your CEO or executive director.
Mm-hmm.
You know, the form that SBA put out yesterday is not really designed for the nonprofit organizations because they talk about ownership percentages and things like that. So there may be a revised form that's more oriented to nonprofits. But as of now, I would say the applicant would be your CEO or executive director. The highest ranking officer in the organization should be the person who signs the application form.
Yeah, okay. That sounds good. We're going to take questions now and keep going through questions for probably about another 10 minutes. And then I'm going to turn it over to Kate for a little while, who's going to do a step-by-step. And that'll give us the opportunity to do a couple things. It'll give us an opportunity to show you what the step-by-step process actually looks like for those of you who haven't seen it yet. But then also gives us a chance to go through some of the open questions and really target that final question period. So a couple more questions before we do that, which is, in the overall calculation of 500, Lee and Gabe, there was some industry guidance that came out at one point that led some of us to believe that organizations that have more than 500 employees would be eligible for it. And I know that in EIDL, for example, there's it's actually operational budget that's one of the determining factors.
So to our knowledge, in the PPP, the only organizations or companies that are eligible that have more than 500 employees is basically NAICS Code 72, which is restaurants. We're not aware of any other provision in the CARES Act or anything issued by SBA that expands the number of eligible NAICS code organizations beyond that which was provided in the CARES Act.
Okay. So if an organization has furloughed staff but did not lay them off, and they are looking to call back a percentage of those furloughed staff, do you reflect that as reduced headcount from the comparative period for the purposes of either EIDL or PPP?
Well, I think for purposes of this program, furloughed is the same thing as laid off if you're not paying them.
Mm-hmm. All right.
There might be something I'm missing there. They would be unpaid headcount, and I don't know how that would be viewed by the banks or by SBA. They're just furloughed. I mean, I'm assuming if they're furloughed, they're on unemployment compensation as if they had been terminated.
Could be if they're part-time, for example, or seasonal, they may not have applied for unemployment.
Yeah, so if they're seasonal, then you go back to the seasonal business measurement standard. It's really it's really case by case. I think it's hard to sometimes give you hard and fast rules here, but your bank is going to look at the headcount and what you've done, in certain measuring periods, and tell you what they believe your maximum loan would be, and then what the maximum forgivable amount is going to be.
Mm-hmm. So the next question itself is a little bit broader, and then I have a more specific one. So in terms of different CARES Act provisions, is it generally more advantageous to take the PPP loan or a payroll tax reduction program loan? Or pursue that?
I believe you can do both. I don't think there's it's not one or the other. I believe that the PPP is open if you qualify, less than 500 employees. Well, and the payroll tax credit is open to all companies, all businesses and nonprofits. So I don't think there is a choice to be made there.
So the next question,
I could be wrong, but I don't think so.
Okay. The next question I'm going to ask, I think I already know the answer to myself, but it's, will all banks ask for this exact same documents, or does it vary depending on the bank? And my answer to that question, and you can correct me if I'm wrong, Lee, is that the lenders themselves have received some guidance very recently, and we're going to post that link through SBA on our website. And it gives them pretty specific instructions on what they're allowed to charge for or not charge for in terms of fees and other things.
Yeah.
But I don't think it extends guidance directly to all the different documentation they might ask. So I would think that they may be reviewing the loan application, but then being your lender and knowing you, they may ask for some other things to help them.
We think that's right. So for example, I completed the SBA form that was released yesterday on behalf of our company. And I told my bank that, and they said, don't use that form. We're not going to use it. So I think the banks will have their own forms when it comes to the application. Now, it won't be radically different than the one that SBA issued. There's certainly going to be the same certification requirements that SBA had, but there might be some variations. And then, the banks may require more extensive payroll information, and they might include or require a profit and loss statement, balance sheet, or other financial information about your organization. They shouldn't. Theoretically, these loans are 100% covered by SBA. So, I mean, they could give a loan to an organization that's got terrible credit. They'll still get 100% back from the federal government, from the SBA. But banks are banks. So they're going to go through their own process and be comfortable that the borrower can pay back the money if it has to.
Yeah. So we're just some general information that I think is relevant here that we can all answer collectively. First of all, the difference, say, between furloughed and laid off. Furloughed has some benefits that are generally provided to them. And so at some institutions, some furloughed employees had, say, sick or vacation hours that they could use, or were eligible to continue receiving some benefits, whereas, you know, laid off is essentially almost terminated in the organization. So,
So furlough, so that means, so for example, you know, included in payroll costs would be vacation costs, separation payments. So you could argue that a furloughed employee who is still being paid on payroll, but because she has stored up vacation time, still counts as an eligible payroll cost and as a partial FTE.
correct. And then I can kind of go to guidance in the PowerPoint itself if you'll direct me to the particular slide, Lee or Gabe. But this particular question asker said, we thought that the employee retention tax credit, the refundable payroll tax credit for 50% of wages paid from employer to employee only if no PP loan. But can you, but you just mentioned that you can apply for both. So can you clarify that?
Yes. So I guess my belief was that you could get both, but I may not be correct about that. We'll have to look at it and see if you can get the withholding tax credit as well as the PPP. I mean, in a sense, they cover different things, right? Because the withholdings are excluded from your eligible payroll cost under the Paycheck Protection Program. So you're not going to get a loan based on your withholdings for federal income tax or for FICA. So logically, it seems to me you could also apply for a tax credit against your FICA, against your payroll taxes that you're withholding. But I'm not certain about that. It's not double dipping. We can say that for sure, because again, you exclude FICA from calculating your loan amount under PPP. So you could theoretically, it seems to me, get a tax credit against that FICA under the payroll tax credit program.
So the next questions are a little bit more related to individual guidance regarding unemployment. And just a couple of questions there, and then I have a comment as well. Are we able to say anything about assistance with unemployment compensation, say for an organization that self-insures? Would be a part of that, or is the loan amount affected for partial claims filed through unemployment for employees who have a reduction in their pay?
So these are employees who have been laid off?
Right. So if we're, so if there's unemployment insurance or unemployment compensation, that question, I think, we're going to start looking at that as an association of how we help the individual who's been furloughed or been laid off as a focus of perhaps another webinar. But is the other question is, does the loan amount get affected for partial claims filed through unemployment? So is whatever percentage of your employees that have filed for unemployment, does that go against your forgiveness?
Yeah, to our knowledge, the filing of unemployment claims by terminated employees does not directly in itself affect the loan amount or the forgivable amount of the loan. I mean, it might in terms of the calculation based on the headcount we talked about earlier, the headcount test, but because they're receiving unemployment compensation, that would not be deducted necessarily against the amount of the loan or the forgivable portion of the loan.
That's great. Okay, one more question and then we're gonna cut over to Kate. It's a more general question about what mark, Lee, you feel like people should shoot for, which is if they feel that the loan provisions would not be 100% forgivable, or are they eligible to apply for, say, less or based on a smaller workforce? Should they and could they do that? Or is the test and the standard going to be more of a straight rate based on those 2 to 3 months and 250 and or 2.5, as you mentioned?
Yeah, so the maximum is the 2.5 we talked about on average monthly payroll costs. You apply for less than that, less than the maximum. There won't be a restriction in that respect. But because the funds are principal interest free for at least 6 months, seems to us you should apply for the maximum and then maybe hold in an account somewhere the portion that you're not certain, if you're going to be able to spend. And if you ultimately don't spend it, you can pay it off back to the bank with no prepayment penalty. So we don't see any reason not to get the maximum loan. If you want to be conservative and say, look, my maximum is $200,000, but I'm only going to spend $100,000. Well, get $200,000, put $100,000 in the bank, and then pay it back if you have to, using the money you put in the bank. I can't think of a reason why, unless you don't trust yourself not to spend that money, I can't think of a reason why you wouldn't go for the maximum amount of the loan, even if that's more than the forgivable portion.
All right. So last question is a quick question before Kate switches over. I'm going to stop my share and allow Kate to pick up. But as we transition over, I think there's some question about if you have employees that are hired through a temp service and how that works. My guess is that if that temp service is a 1099 contractor, that the employees are going to be they're going to have to go for unemployment through that contractor, not to you. It would only apply to anyone who was an employee on your payroll.
That's right. So it's just really a payroll test. So if you use temps from somebody else's payroll, you can't count them on your payroll because that organization might very well count them on its payroll. So we're really looking at your payroll employees, again, full-time, part-time, interns, seasonal employees, but they have to be W-2 employees of your organization. They can't be 1099 contractors, nor can they be from some other company that is paying them as a W-2.